Hey guys, welcome back to the channel. I'm Luke, a CFA Charterholder. Today we're going to run through some of the differences between debt and equity investments. So yeah, let's get into it. Okay, so some of the characteristics of debt and equity. I have a slide here which summarizes all the key features of both equity and debt and how they differ between one another. So this is really all the key characteristics and features of both sources of financing that you need to know for the level 1 exam. This is relevant to the corporate issuers section of the material. So this is what we're going to focus on, both equity and debt, the characteristics as a source of financing from the perspective of a company, but also the risk and return characteristics from the perspective of the investors who are providing the capital to the company. So we have equity on the left-hand side and debt on the right-hand side. So let's start with the first line. So time horizon. So equity is a perpetual instrument. So when you issue equity as a company, you're effectively issuing the capital forever. There's no promise of capital repayment to the shareholder. There's no fixed date when you need to repay that equity capital by. It's effectively in place forever. Whereas debt often is a finite instrument. So when you take out debt, typically it could be a 5-year term or a 10-year term or longer, depending on the nature of the contract. But it almost always has a fixed date when the principal payment needs to be repaid by. So again, that could be 5 years, 10 years, 20 years. It really differs depending on the nature of the agreement, but debt tends to be a finite contract which has a predefined ending date. The claim on cash flows, so equity holders have a residual claim on the firm's cash flow. So when it generates profit, once all stakeholders in the business have been paid, so the suppliers, the employees, lenders in the form of debt interest cost, governments in the form of taxes, once all those costs have been deducted from revenue and you're left with net income, those profits are what are made available to the shareholders in the company. Once everyone else has been paid, the residual profits, the residual cash flows belong to the shareholders. Whereas debt contracts provide fixed cash flows to debt investors. Debt investors are promised fixed interest and principal payments. Companies have to make the predefined fixed debt payments to their debt investors, to their lenders. They can't pay any less because that would be a breach of the debt contract. They have to make those fixed payments. So debt investors are said to have a fixed claim on the company's cash flows. Similarly, when it comes to claims on assets, in a bankruptcy scenario, equity investors have a residual claim, so they're paid last in a bankruptcy. Whatever's left, whatever assets are left once all the other creditors have been paid out is what goes to the shareholders. And debt investors have a fixed claim on assets, so they often will agree collateral as part of the debt contract. So those assets, if the firm can't make and meet its financial obligations, they have a fixed claim over certain assets of the company. Return potential. So equity offers unlimited upside. So the profits that a shareholder can earn are effectively unlimited, whereas debt investors have capped upside. The most they can earn is the principal and interest payments on the debt. There's nothing more they can earn, whereas shareholders have unlimited upside potential. There's no cap on what a shareholder can earn. If the business is successful and really successful, it could effectively earn unlimited profit, which we pass through to the shareholder. Whereas from a loss perspective, the most both equity and debt investors could lose is their initial investment amount. So if you think they provided capital, if the business was to fail, theoretically the most they could both lose is their initial investment amount. Equity holders have limited liability, in a company, so they can't lose any more than they put in. And similarly, debt investors are also limited to how much loan capital they provided to the company. The only caveat to that is debt is more senior in the capital stack to equity, so they will get paid out first in a bankruptcy scenario, as we mentioned on row 3, debt has a higher priority to equity if the firm is to go bankrupt, so they would be paid first. So there's more protection for debt investors. And that follows nicely on to the next point. So investment risk is higher for equity than it is for debt. Naturally, there's a higher risk return profile for equity. There's potential to earn higher profits and higher reward, but that also comes with greater risk. If the company is to fail, then the chances of equity holders getting paid out is lower than it is for debt holders. So the investment risk is significantly higher for shareholders. Desired outcome. So what are the objectives? What do the investors or provider of capital want from company managers? So shareholders want company managers to maximize firm value because that translates to higher shareholder value. So they will want management to act in ways that maximizes the company's value, whereas debt holders are more risk averse. They want to prioritize timely debt payments that are made in full. So they have no access to the profits that are generated if the company increases in value and takes on more risk. They've got no access to that upside. So what they want is for the company managers to take actions which will prioritize and maximize their ability to make timely debt payments. So that's typically by taking on less risk, not no risk, but a conservative level of risk, and investing in projects which are cash flow generative and allow the company to be able to make the debt payments in full and on time. Whereas shareholders will pressure management to take on a lot more risk and invest in projects which have potential for significant upside potential and high profits, etc. Voting rights. So equity comes with voting rights. So shareholders are able to vote on key corporate resolutions. They can vote on changes of CEO, changes of board, potential acquisitions, changes in strategy. They've got a lot more say on the strategic direction of the company, whereas debt holders have absolutely no voting rights. So they have no say on the strategic direction of the company. They can't vote on key resolutions, and they can't really sway company managers to take actions that are in their best interest when it comes to their vote. Tax. So dividends are not a tax deductible expense from the perspective of the company, whereas interest expense is a tax deductible expense. So the company benefits from the tax shield on debt interest. That means that the more debt a company has, the greater its interest expense, and the greater its interest expense, the greater the tax benefit it gets, because interest will reduce the tax payments that go to the government. So there's a benefit to the company of raising debt, whereas dividends, in contrast, are not a tax deductible expense. Risk from the perspective of the company. So equity is low risk because there's no promises made to shareholders. The company hasn't got to commit to making guaranteed dividend payments. It's not going to promise repayment of capital by a certain time period, 4 or 5 years, etc. It's a perpetual instrument. There's no guarantees made to the shareholders, no promises. So it's lower risk from the perspective of the company, whereas debt is high risk because you are making promises to the debt holders. You're promising to make your interest payments. You're promising to make your principal payments on certain pre-agreed dates in full. You're posting collateral, which the debt holder could take if you fail to make your debt payments. So there's much more on the line for the company when it comes to debt. And then ownership dilution if new equity or debt is issued. So there is dilution for existing shareholders if new equity is issued. So dilution is where the size of the company may increase if you issue new equity, but the percentage ownership of the existing shareholders will decrease because new shares are being issued. The pie, the absolute value of the pie is getting bigger, but the proportional share of each shareholder's ownership in that bigger pie is getting smaller. So that is a downside if you want to issue new equity, whereas if you issue new debt, there's no dilution because there's no ownership in the company, which takes place with a debt contract. Debt contracts don't provide any ownership rights over the company to debt holders, so there's no dilution effect in place. Cool. So hopefully that was a helpful side-by-side when it comes to the characteristics of debt and equity. It's really important to know all these things before going into the level 1 exam. There are some characteristics here that are often tested, and you'll need to be able to contrast the differences between debt and equity instruments from both the perspective of the company, but also the perspective of the investors. So things like claims on cash flow, voting rights, tax deductibility, risk from both the investor and company's perspective are things that you're definitely going to need to know going into the exam. So hopefully that was helpful. Any questions, let me know in the comments, and I'll see you guys in the next video.